Let's try that then. Get an audio check. Yay. Turns out you just have to pull a Gibbs and unplug it. Appreciate that. Might be time to get a new headset. All right, so the founder's note from Spot Gamma has not yet been updated. We're still looking at yesterday's. But the number from last night was so impressive that I wanted to point it out. And the only way I could really do that is if you all understand what the number means. So this is the Spot Gamma dashboard from the founder's note from last night. And hey, they just, nope, they haven't updated yet. So this is last night. It's the PM edition. When he does get around to putting in the AM edition, I will share it out. But the number that I wanted to look at down here is the Spot Gamma Index. It's proprietary. You can't get it anywhere else. This number goes from a -4 all the way up to a +4. So it's not the highest reading ever, but sitting at a 2.2, that's very high. All right, so what does that number mean and how do we use it? A large positive reading is a forecast that future realized volatility will be relatively low with smaller trading ranges. That's the key words there, right? If you miss everything else, maybe it's too nerdy, too early in the morning, keep that in mind. With relatively low, smaller trading ranges. And if it was a large negative figure, then we'd be looking at expecting larger trading ranges. All right, so again, this was from last night. The number that we get this morning with the AM note may be smaller than that 2.2 that we saw, but it's what you're going to want to expect today until proven otherwise is trading in a tighter range, not an expansion day like yesterday. It's just one piece of the puzzle, right? We don't base everything off of this number. It's just good to know where that number is on a day-to-day basis. Europe had good numbers on inflation data, so everybody was really happy. That kind of gave stocks a lift around the world. Small caps are doing the best. They're up 1%. And when you think small caps, think of the NYSE and the Russell, right? I know the NYSE is not just small caps, but lump it in there together, right? So the UK up 1%, NASDAQ up 0.75%, and then Japan right behind them. The S&P at 0.5%, and the Dow at 0.25%, sitting comfortably with China down there on the lower end. But everything green on the screen. Now, is it because we're still in this semi bubble, right? Semiconductor bubble and tech bubble? Or is it more of a reflexive bounce and a trip back towards the mean? That's really kind of the answer, right? Is we know everything's going up, but are we supposed to sell the rip or run with it? For economic data today, we really don't have any. It's more Fed speak than anything else. Now, around the world, we do have economic data coming in, but coming out of the US, we really don't have much. Always on Wednesdays, unless it was a holiday week, we're going to get the EIA crude report, and we'll also get the inventories, right, for the US petroleum inventories. With it being, with us working into an election cycle, keeping a strangle on energy, a collar on it, keeping it within a channel, not letting it get too high, and yet it can't get too low or we'll upset too many apple carts. This also needs to stay low for other reasons, right? It directly connects to inflation. So energy's kind of a big deal. And right now the market is searching for anything that can adjust the Fed's perception of the rate cut. So while we very often just kind of shrug when we get the oil report, you'll want to pay particular attention to the clock. Your trading view calendar says 8:30 PPI. It's possible that we have a PPI today. I don't think it's going to be a large impact if we do, but what you're probably seeing on your trading view is a PPI from another country. Thinkorswim does that quite a bit, right? They won't differentiate. So if we go in here and look at calendar, very often you'll see something really early in the morning like PPI or CPI, and it turns out to be Canada's, right? Not ours. Or there'll be one late at night and it'll be Australia's or Hong Kong or Japan. So always want to dig a little deeper, but this is why we go to multiple sources in the morning rather than just one. If we come to this place, Market Watch, they really only hit the highlights. They don't dig down into the weeds, and they almost never show something from another nation. So this one oftentimes won't show anything at all. And then if we go to FX Street, well, they want to show you everything under the sun that they can find. And they have their little impact gauge, which is nice. And they show places from other nations. I really like that. But what they don't do a good job with is they don't catch Fed Speaks appointments if they were not posted soon enough, right? So say Goolsby wants to speak tomorrow and it wasn't published quick enough, it won't show up on FX Street. But Finance Juice does a really good job of catching those last minute Fed Speak appointments. It also does really good with the global perspective, catching places from around the world. There's your UK PPI input from this morning. That was that Euro data that I was talking about that came in really good. And Finance Juice is also where I tend to spend my day after we get into the regular trading session. I keep my eye on this place for updates, news. I turn on the tick strike, and yeah, so it's why we check multiple places, right? Maybe there's some kind of glitch on TradingView that is showing you a PPI reading that shouldn't be there, but checking multiple sources, make sure you don't fall down into a false sense of data. Check and then double check. A lot of times I still come here to Thinkorswim and check theirs anyways, even after checking all those others. Thinkorswim very often has those lunchtime auctions, even when others don't. So it seems like overkill where we've already hit 3 different sites checking on economic data for the day. Why would I come here now and get number 4? A lot of times those other places won't show those auctions and Thinkorswim will. And you know, the craziest part is there's 50 to 100 economic data prints that come through every single trading day. Every single trading day. But they're so far down the rabbit hole that most of the time they never reach the news. Grain shipments out of the New York harbor, for an example, just one data point. There's tons of them. So even after 5 websites, when you think you've got them all, you didn't get them all. You didn't even scratch the surface. That is a good point. Today is the OPEX for the VIX. And Friday, of course, what we've all been focused on is OPEX for the rest of the markets. So that's something to keep in mind. Next month, we're going to get OPEX on the futures, right? We're going to expire in March for the futures that we're on. And so that OPEX will be an even bigger one. But we do have options expiration. And if you've been following along with those spot gamma notes that I post, the founders notes, you'll have this impending urgency kind of riding on your shoulders, because those founders notes do a really good job of explaining how this options expiration can greatly affect not only our trading day in the S&P, but broadly in the rest of the market. So it's a good read. I know it's a lot to take in. They use language that if you haven't worked through their educational materials seems a bit much, but they have videos on YouTube. I think you can get to a lot of their blog posts, even if you're not signed in or don't have an account, because obviously they want you to understand their tool so that you'll buy their product. And a lot of people won't buy the product if they don't understand the tool. So they have to make the resources available to people, even if you don't have an account. I'm not trying to sell you an account there either. I like their service. I use it constantly, but if you're not yet consistently profitable, it's hard to argue about buying more services. It's one of the reasons I try to share as much of it as I can. Save you from buying it. All right, well, let's just start with the weekly. Top down, as usual, generally will get us a lot farther than just staying honed in on the front. So this is last week's trading range. We've got that 50%, that halfback level, so to speak. We're there. 49.93. There's a possible cog line at 91. I say possible because I have not validated that 91. But it's definitely on my radar, so I keep my eye on that spot. All the 91s, right? 48.91, 51.91. I don't care where it is. If it's a 91 on the ES, I watch that spot. The next cog down is 32, 31, 32, and it's at the low of the week. It's the low of yesterday. We didn't get there. We just got close. Right now, we're just really struggling with that halfback level. There's a monthly high. I know we don't normally go this far out. I do. I just don't normally do it in the morning briefings. But there was an interesting push off of it yesterday. I'm not seeing it on a 15-minute chart, but when we came up and hit it yesterday, it was one of the plays that we got that rejection. We buzzbeat off the bottom of it. So now we've left an imprint there. If we head back down again, we could see another imprint against that, at least a form or reaction against it. It's worth keeping an eye on it. Otherwise, we get into measuring yesterday's bar, and it might feel like, we're measuring the week again, but we're really not. 49.88 is the halfback. It's really all we want. We just turn this other stuff off, try to keep things as clean as possible. And as usual, they line up on something. So that 49.88, it's the halfback of yesterday. We can go ahead and turn that one off because it lines up with this level right here. It's the RTH of yesterday, the RTH high. It's also a part of my pivot point channel. So there is a channel here around my pivot point. It's just math. My channel is from an old pivot point book. Doesn't really have any weight to the discussion we're doing here. We're back through the 10-day moving average. We have an inside day breakout if we're only focused on the RTH, right? Obviously, yesterday was a really big day, and measuring it from high to low, there's a lot to take in. But if we only focus on the RTH of yesterday, then there's actually some pivots that we can lay out. But before we get to those, it's worth laying out these other ones. That halfback level, the monthly high, the daily pivot point, weekly pivot point, and oh yeah, we already hit the ADR half. A couple of things about that ADR half. If we hit it really early in the morning, we can actually go to the other side by the end of the day. So there's that piece. Then there's the reflexive bounce question. Is this just a mean reversion reflexive bounce back to the upside, or are we going to continue with this semiconductor bubble and tech bubble and continue the rally to the upside? From that perspective, we had a really nice moving average bounce yesterday, a 20-period bounce, very similar to this back here, where we broke the 10, came down and tagged the 20, and had a really nice run from that. Same thing back here, where we tagged the 10. We only made it back to the top, which is what a TRB owes us. But same logic. Now, you know, you mentioned a moving average bounce to somebody, and you can just hear their eyes roll. Nobody wants to discuss a moving average bounce or try to play a moving average bounce. And of course, when you're in a sideways market, that holds true. There's no value to it. There's not even worth looking at it. But once the trend is established, these levels are watched by tons of traders, whether they want to admit it or not. And where that 10 and 20 is oftentimes a line in the sand to stay in or get out of a position. Odd as that may sound. Look at a lot of profit-taking manuals or books or education, and it'll talk about using a generic moving average as a line in the sand to exit positions before they give away too many gains. Right now we're focused on that 10 because we kind of need to get back above it. If this is just a moving average bounce, then the target at the very least is back to the top of the zone. So just like back here, we came down and we came right back up to the top of the zone. If it's going to be more than that, then after we get back to the top of the zone, we'll look to expand at least the distance of the pullback to the upside beyond. Well, that's easy enough to measure out, right? You can use your Fibonacci's, but I like these quadrant lines. Either way, as long as you've got a half and 100. So this is what I just measured. That's 50% of it, and that's 100% of it. If you don't have a fancy drawing tool like that, just draw a box. Take that box and set it up. Just put the bottom of it where you started, and look at that. Even if you don't have a fancy tool, you can still do it. We're looking at 51.96. You might as well just say 52. 52 by FOMC sounds pretty good. We got to do the thing though, right? We're halfway through February already. So if that's what we're going to do, we need to do it. And I think that's going to really solve the argument about, is this just a mean reversion bounce and we're still looking to continue lower, or is this going to resume the trend? We ought to know very quickly. So if we continue to go sideways like this zone back here, then if you kind of eyeball that same thing, we had an up move to kind of get that mean reversion a little bit, and then we just stalled there, playing around in all that trash. We would expect, if we're going to mean revert, to not get back above yesterday's high, the full high, not just the ADR half. I wouldn't even expect 3/4 of it if this is just a mean reversion bounce. So we'll be looking to resolve this ADR half. If we can get through it, that round number, we've moved through that round number so fast, we didn't even leave anything behind. Not expecting to leave anything behind now. should be able to go back through it relatively easy. The pivot point on the weekly time frame is not considered support or resistance. It's just a level or a gauge of where we're at. But then we have the call wall, 5017. It's very likely that we could get a little bit of a reset at that call wall, but more likely it's going to be this gap close, right? We did mention the gap close. Whenever price leaves the zone really fast, we consider it a liquidity gap. That gap needs to be filled. The greater the violence when price left that area, then the more strongly that gap is created. So even intraday, you get some moves like that. They're considered liquidity gaps. It's not technically unfinished business because it was expected. It was a data point, 8:30 data point. But if that was midday and you got a move like that, then it would be considered unfinished business. Traders didn't get a chance to get their trades on, and they're going to take that chance the next time price gets there. The ADR levels, all things considered, seem very close, but it's likely just a projection of how big yesterday's move was. We're back above 0 gamma. We're back above the volatility trigger. We're just going to take all of that stuff off for a moment. Just kind of clean things up. This fits with that gamma reading from the founder's notes. Very tight range, not really doing much. Then we got that economic data out of Europe, and we had a nice expansion. How much is the U.S. markets going to take this good news, right? Is it good enough? That's going to have to be a part of the discussion. Now that we've stripped everything down, we can do some analysis on yesterday's RTH price. We already know that the entire day gave us that halfback level, but it lined up with the ADR, so we don't even need that. We had the breakout, which tangled up into the warning center, which was also that halfback level on the week. So we pulled back, got a little bit of a Busby, and we're trying to break out again. We set that higher high. So far, so good. But this needs to continue. We need to continue setting these higher highs and these higher lows. Drive up into the yellow line, the full ADR. Now that's only going to get us up to the gap close. But in the grand scheme of things, if we're looking for a market that is healing itself after that big move, then getting back up into that 50-32 cog line will resolve this really big candle, and it may take some of that anxiety away from the market. Just kind of calm things down a little bit. It went beyond profit taking yesterday, where everybody just started piling into the short. Spot Gamma did a good job of talking about this bounce near the end of the day. I tried covering this in my posts. At 3 o'clock, we all start looking for power hour. But have you ever really asked why the last hour of trading often sees really big moves, generally in the opposite direction the market had already been going? I'm sure it's not the answer to everything, but one of the things that I tend to focus on when we get to 3 o'clock is how did we get here today? And has that changed? So if you're not aware, treasuries, the dollar index, those things close at 3 o'clock. If the dollar is the reason we were falling, or if the 10-year is the reason that we were falling, or both, and they close at 3 o'clock, we can often see a move back in the other direction because they're closed now. There's less weight against us from them, right? There's less impact from them. So I don't look at every day at 3 o'clock expecting a big move. I kind of reserve it for why are we where we are today at 3 o'clock, and is there any reason to think with these particular markets going into the close at 3 that we can get a change. And so then we just start looking for those changes. You can run, flow tools on Trading Tick in the Discords, kind of get a feel for what's going on in the optionality and try to spot that turn. And then all you need is a breakout to play it. So it was a good turn, but it came a little late because we sat down there digesting a little bit before we started to make that move. But the signals for the turn were there. We're going to lose more of this Wednesday volume back here. We set this low yesterday, so that's going to stick as the low of the point of control or the volume profile unless we break that low. That's a perfect drop base rally signal, by the way. Swing low, textbook. I mean, it doesn't get any better than that. So this is pretty much what it's going to look like after we lose that data. This will be the bottom of the volume profile, 40, call it 49.40, is we're going to lose this through the day today. The only reason that it wouldn't be our new low of the volume profile is if we break yesterday's low and continue to go lower. That would expand this back out again. So with that in mind, once we lose all this back here, what are we left with? I mean, it's still kind of a nasty mess, but it could be considered that capital D. If we were to get some more volume across the top here, a better argument could be made for a capital B. But this volume up here is just too diverse. This lower level is good. It's just really this top level that we got to mess with. And when we talk about air pockets of risk and falling into a hole and how price can move through that zone really fast because there's nothing here, that was a good example of it yesterday. You see how shallow it is? There's just nothing here. And when we broke, it just, there was just nothing to help us out. The point of control, could have assisted in some way. I don't really see it that way, but it's possible. Either way, this collection slowed everything down, got us into liquidity, even if we did overshoot it a bit. So we can reevaluate this profile later today, but I'm still focused on Friday and getting rid of all this volume down here. As long as we don't break yesterday's low, then by Monday, 49.30 should be the low end of the profile and 50.70 the high end. It's still a pretty tight 10-day. We don't have a VPOC to carry forward from yesterday, and we broke that 60 yesterday, both down and up, so we'll take that one off. We broke the 50.11 or the 50.12 cog line. That's an older one. We ran through that one like it didn't even exist. Of course, it was during the data print too. So we still have 50.42. And if we continue moving to the downside, 48.92. There it is again, another 92, 91. That's a cog line, I'm telling you. I can't prove it yet, but it's a cog line. There's no discrepancy between the TPO and the volume profile this morning, not yet. It looks like we got into some volume right against this high, really high volume compared to how long we stayed in that zone. So there's a little bit of a discrepancy. It's like we ran up into liquidity, right? Multiple times though. We ran into a lot of liquidity right here. And sure, I mean, we spent a little bit of time there, but a bigger level or maybe a matching level, price ran up into that. It was just above this high. So that high was made. price came up and went beyond the pivot because liquidity resides on the other side of the pivot. It just shot right past it, got into all that volume and was rejected. But it didn't fall. It didn't crash and burn. We're coming right back up into it again and right through it again. We can see that we're not spending much time there relative to the amount of volume there. So it was a large amount of volume, but it didn't shut us down. In fact, we're back above it again. So now could continue to focus on that as a possible liquidity zone, unfinished business, however you want to put it. Is this now where a bunch of buyers are sitting ready to buy more? You can watch the dome check pulling and stacking and see, right? And then cumulative delta, things like that. And we'll be looking for another one of these up here somewhere, right? We had one when we ran up into that zone. We had one when we ran up into that zone. We're looking for the next one. Could be up in the 20s, but that'd be higher than any of these others by a considerable amount. You could just measure this distance and plot it to the upside. All right, so we got a little bit of a reset on the daily, but since we're on the weekly, we'll start with it. 2.76% away from the 10-week. So we're on the decline. We've been in a situation where we started a decline before and then we rallied back out of it multiple times. You can see we started to decline and rallied again, and we rallied. So one decline doesn't really hold too much weight. Same thing back here. We declined, but then we rallied. All those times without getting back to zero. So just because we're pulling back doesn't mean we're going to pull all the way back to the 10-week. Remember, the 10-week is kind of like the 50-day. It's not perfect, but when you're on a daily and you have a 50, you got a pretty good idea where that 10-week is. And if you're on a weekly and you're looking at the 10, you got a pretty good idea where that 50-day is. It's nice how that works, right? It saves you from having to go back to the old chart and swap your indicators out, change your moving averages just to get those numbers. So you get a little bit of a feel for where price is. We're not looking for a 50-day moving average tag, right? We were just looking at the daily a few minutes ago, and we interacted with the 20, not the 50. I do have a strategy that I put together a long time ago that talks about how soon we break out of the weekly expected move, up or down. And that if we do it on a Tuesday, that it's a good time to take the other side of the trade. And yesterday fits that argument perfectly. And it kind of goes into the logic or adds to the answer of, is this just a mean reversion bounce or a continuation long to the upside? Generally, statistically, if we get outside of the expected move edge Monday or Tuesday on the downside, you're good for a long in the other direction to at least the end of the week. It's not guaranteeing that you're going to get to the other side per se, just that you'll get back above that weekly expected move. So if you was playing something bullish neutral, like a put credit spread, then you would play it with a break even at or below the low of last week, or the low of the weekly expected move. It's not the same as buying a call, aiming for the high of the weekly expected move, though, because that would be a bullish trade instead of a bullish neutral trade. Having said that, though, the logic does fit, just like with the ADRs, that if we get to the bottom early enough, we can go to the other side, because that's how we treat the ADRs. I mentioned it this morning, as a matter of fact, that we already hit the ADR high early enough in the day that we can now go down and hit the ADR low. so far the logic fits. What you're really going to want to focus on, though, is yesterday's range and that 50% mark. If this was a trend to the downside, even just start of a trend, when you get that pullback for a continuation, the pullback should not pull back too far. It just shouldn't. If it pulls back too far, it's not a pullback. So, old example, we got to the edge on a Tuesday, started making our move back in the other direction, even rebounded from that. And we just came right back up to the top. But this made it through that 50% level. So come back to this. We're through the 50% level. What do we do with it? You know, if we're going to look for that short, it's got to get back down below. So you could argue, as long as we stay above the weekly range, which also happens to be that half back, pretty close, 8 points different. As long as we stay above the 50% mark, then the bullish neutral position holds. But not being bearish doesn't necessarily make us bullish. So the argument to get back up to 5,100 by the end of the week, we'd have to ask, where's the fire going to come from? Where's the gasoline to fuel the fire going to come from? On the daily, we did get our reset, and man, we needed it, right? We've just been chopping and chopping and chopping, and we got a reset back here. Same thing again, just a lot of chop, and we got our reset here. So this bodes well for the argument of a continuation to the upside. A lot of analysts have talked about and pointed to different tools that say this drive isn't done. But there are a lot of conflicting pieces of the data, right? CTAs, VC funds, these non-discretionary funds, they don't pick and choose, right? They're not reading signals and candles and all that. They have strict criteria, and when it says that they have to buy, they have to buy, even if it's breaking out into all-time highs. And a trader is sitting there thinking, who in the heck wants to buy it at all-time highs? Those funds will. A lot of those funds were record long coming into this options expiration. Not never before seen levels of long, but they were staggering numbers of the amount of money that was in the market long. And it's going to be expiring this week. So what are those funds going to do? Are they going to re-up with strength into more longs, or are they going to look to play sideways or short? We don't have that answer yet, and it's not going to come from the candles. So no amount of technical analysis can give us that answer. We literally need options expiration and then to come in next week and start looking at the numbers and see what we have. So 5,100, 5,200, it's hard to give any kind of answer on the future until we get on the other side of OPEX. The key of that, though, even though it feels like that leaves us helpless or, blind, is knowing that the data isn't in the candles so that we don't spend time and effort spinning in a circle, frustrated that, we're reading something in the candles and then it didn't happen. We know the data is going to come from OPEX and that we'll get those numbers and we'll know more Monday. That used to really frustrate me as a swing trader. You'd get the daily chart and it'd have all the signals, everything you need. You'd think you're ready to go, and then price would do absolutely the opposite. But if you didn't keep in mind that there was an FOMC or a CPI or a PPI or OPEX or anything else that could affect that, then you were only looking at the pattern and you didn't realize why the pattern didn't work. The FANG down is down, which makes sense since we're getting a little bit of a pop globally. Everything around the world is up to some degree. And the VIX is down 6%. Take it to the other side, we have Bitcoin, China ADRs, the semiconductors, the Magnificent Seven, solar, the Magnificent Seven again, banks, just literally everything, right? We get down far enough and things like the bonds aren't up by very much. Biotechnology is skirting the edges of what we need. We need 0.5%. But we've got consumer discretionary, transportation. You Dow theorists will love that. Energy. This is the kind of day where you can throw a dart at a barn and you're likely to hit something. So, you know, some days it's really a stock pickers day. You have to be very particular. Today, not so much. It seems like anything you try to put your hands on is getting some sort of mean reversion. The question will be which sectors lead the most or that we're going to get the most out of. And is it all done before the bell even rings? Let's see if we can get that founder's note. Yep. Short and sweet, this one is. They're still calling 4,900 a major risk off break. So as long as we're holding in the SPX above that 4,900, then we're not going to see any real flash crash kind of behavior. They're calling for directionally neutral until we're back above 5,000 in the SPX. So that kind of goes into the discussion we were having about, you know, not being bullish, more of a bullish neutral, right? It's always nice to see that I got the same answer as somebody else, right? That we're not kind of just sitting off in left field by ourselves. All right, well, I'll get this posted into the Discord so you guys get a chance to kind of read it, you know, take your time on it. I was expecting the gamma index, but that's all right. We want a rally from more than Bitcoin and pot stocks and China ADRs, right? We want a sustainable rally. It's going to have to come from tech, from semiconductors, you know, some sprinkling of financials, consumer discretionary, not from these things. That's like building a house in the sand. It's just not a good idea. So this rally with this backing it up is not really all that exciting. We need more. Having said that, though, a lot of these names, like the Bitcoins, they are getting this flood of money. So if you're looking for day trades, I mean, sure, you know, not swings, definitely, but some day trades. Uranium's going to be a slower play. Pot stocks had been in a strong squeeze. I mean, they've still got a long ways to go, you know, to kind of get back to any sort of where they used to be. Everything is trapped inside of yesterday's range. So if you find things that are breaking out of yesterday's range, then you're ahead of the group. Since the range is so big, if you're looking at playing an equity play, do exactly what we did on the ES. Break that very big day into pre-market versus regular trading hours. Because you'll find, like on the ES, that a lot of things have already broke out of their regular trading hours range to the upside. So we've already got an inside day breakout if that's all that we're using. And for equities, that means that you'll have a lot of names with a gap to fill, right? If you say take away that RTH range, or I should say, if you take off the extended hours, and if we've already broke out of the range, so Apple, for an example, is at 185.70. Ooh, very close. We need 186.15. And Apple had bad news with those VR headsets. Or Meta, 464 this morning. So it's not broke out yet. It's still inside yesterday's range. Amazon, Jeff Bezos sold another $2 billion of stock in 4 days. Can't believe this thing held up with him selling so much stock. I mean, sure, you know, it gapped down, but so did everything else yesterday, right? And it rallied back up reasonably well. It's at 170 this morning, so it's not broke out yet. But if we get that breakout, the gap close is first target, not just on Amazon, but on anything. If it breaks out, we have a gap to fill, and the gap fill will be a nice target. Same thing with Tesla. We're at 185.70. Long ways to go before we get that breakout. Not Netflix. Netflix closed the gap yesterday. It's at 560 this morning, so it is inside day breakout, but there's no gap to focus on. Find the peak, run the Linreg line to the downside. There's the channel, and this is really ugly, so it's hard to see. You can turn it into a line. That kind of cleans it up a little bit. Turning it into a channel helps. So we were at the low. We're already back up to the high of this channel. We're going to be focusing on all these sellers across the top here. Every time we've broke out of the top of this, sellers have been right there. I mean, look at all these sellers. It's been nothing but selling since that day closed. So Netflix is setting up for a really nice short. It's already at 561. Well, 560 on the bid, but 561 on the ask. So we're, you know, somewhere in the middle of these two. The higher it goes, the better of a short it's going to be. Just be careful because this was a really big earnings gap. And while all that selling is taking place, it doesn't necessarily mean that this is bearish. It could just be a lot of profit taking after a very big move. We're now back above this halfback level, 58, and we need it to keep that. It is, yeah, liquidity gaps, just like any other gap, are in play until they get closed. Now, the only thing that would take that away is, since we're talking about futures and they have a date, if we don't fill this before the March expiration, then we don't worry about it, right? If we got there, say in April, we wouldn't have a gap fill. Stock, on the other hand, doesn't have that expiration, right? So the gap would exist on stock until we finally got it filled. A lot of this ties in with moves in the New York Stock Exchange and the Russell, and a lot of left for dead, penny stock, dash for trash junk that's been coming up off the bottom and getting short squeezed. Solar, pot stocks, that sort of thing. They're up the most this morning. Well, you know, they're in the upper quadrant. Bitcoin's up the most, but behind that, with solar and then you get the China ADRs. There had been a theory for a while about China ADRs versus the Bitcoin proxies, that when we got the ETFs in January, that we were likely going to see a sell the news, and that money would rotate into the China ADRs. It really didn't, though. And all the work that China's been doing to stimulate that, right? They've been increasing liquidity, easing monetary policy, doing as much shadow stimmy as they can do. The results haven't been all that useful. I mean, shit, BABA's up a little bit, Baidu, you know, so you can kind of go through the China ADRs to a degree. But as much effort as they've been putting into it, I would have expected more. Gold and silver, or precious metals, are doing well this morning because of the pullback here in US dollar Japan, but it's not much of a pullback, all things considered. Look at the massive move. We didn't give even a quarter of that back yet. Same thing with the Dixie, or the dollar index. Big move. We really didn't give anything back. And same thing with the 10-year. Really big move, and we didn't give anything back. Notice, though, also, obviously the 10-year didn't move. The bonds are testing the lows, looking like they really want to continue to the downside. Now, this is the 30-year, and that's the 10. But still, bonds fell with stock yesterday. Stocks and bonds both took a punch to the face. Stock's trying to recover, generically speaking, just stock versus bonds. Bonds aren't recovering. There's probably more to that. That's a very nice double bottom on TLT. It's at the 111. So if it's going to turn around, it better do it. Depending on which one of these we like, it's got a nice little zone. So there's our zone. Needs to turn around here. If it's going to be a good classic double bottom, then it will expand lower than the previous low to trap the bears, and then we run back up. I would be looking for bonds to run back up, staying above 92. We can wick below 92. We don't want to close below 92. Not today, not on the week, preferably not this month. This is going to be a big deal. I would keep my eye on this today. For this to start to move up, we kind of really need to see the 10-year go down. So kind of keep your eye on that. 10-year fade with the dollar fading. We should, instinctively see US dollar Japan fade because of that. So we got some levels to focus on. We don't want to see new highs in the dollar and the 10-year. And as long as all of this continues, then we should continue to see the MAG 7 and banks KRE do well. If we lose the monsters of tech and or semiconductors, then this rally is not going to be sustainable with these other things. You can have 99 names in 100 all doing one thing, but if the MAG 7 are going down, the market's going down. If the MAG 7 just isn't rallying, then a rally is going to be hard. A lot of Fed data today, digesting what we got out of Europe first, and then a couple of Fed speakers. Everybody, have a good day. I'll see y'all tomorrow.